For months, the spectre of higher for longer interest rates has hung over the market, a dark cloud of uncertainty and fiscal tightening. Now that cloud seems to be parting, and in its place, a glimmer of hope for a new cycle of growth. We will break down exactly what Federal Reserve Chair Jerome Powell said, what it really means, and how the seemingly simple signal will affect the interconnected worlds of crypto, AI, and traditional finance for the foreseeable future. This is a story about the intersection of the old world and the new. It's about a man in a suit in Jackson Hole, Wyoming, influencing the value of a digital asset like Bitcoin with his words. Let's get to the bottom of it. Our story begins with the Federal Reserve and its two-part mandate from Congress to achieve maximum employment and to maintain stable prices. For the past year, the Fed's primary weapon has been a restrictive monetary policy, raising and holding interest rates at elevated levels. The goal is to cool down an overheated economy and bring stubbornly high inflation back down to its target. This policy has been a headwind for the stock market. Higher borrowing costs make it more expensive for companies to expand, for consumers to spend, and for investors to take on risk. It's the economic equivalent of a cold shower. But last week at the annual Jackson Hole Economic Symposium, Jerome Powell's speech signaled a potential change in course. While he didn't explicitly promise a rate cut, his language was a masterclass in subtlety. He acknowledged mounting concerns about the employment situation and a shifting balance of risks to the economic outlook. This is a significant pivot from his previous, more hawkish tone, which focused almost exclusively on the need to combat inflation. Powell's remarks suggested that the Fed is now also placing a greater emphasis on the maximum employment side of its dual mandate. Now let's connect this to the market's reaction. Before the speech, there was a great deal of uncertainty. Wall Street was in a 5-day losing streak. The spectre of stagflation, a grim combination of sluggish growth and persistent inflation, was a real fear. Analysts were on high alert. The market was essentially holding its breath, waiting for a signal. Powell's careful but clear acknowledgement of employment risks was the signal investors were waiting for. It was the green light to resume their bets on a September rate cut. The probability of a rate cut, as measured by CME Group data, jumped from 75% to over 90% almost instantly. This is where the direct impact on the US stock market begins. We saw an immediate explosive rally. The S&P 500, the Dow Jones, and Nasdaq all surged. The Russell 2000, an index of small cap stocks, saw a particularly dramatic jump. Why is that significant? Small cap companies are often more sensitive to interest rates because they are more reliant on borrowing for growth. Cheaper borrowing costs are a direct boon to their bottom line, so their strong performance is a powerful indicator of this renewed optimism. The impact of this shift is not confined to the United States. The US dollar is the world's reserve currency, and the Federal Reserve's actions ripple across the globe. When the Fed hints at rate cuts, it makes the US dollar less attractive to foreign investors. Why, one may ask? Lower interest rates mean lower returns on dollar-denominated assets like US Treasury bonds. This causes the dollar to weaken against other currencies. For emerging markets and other global economies, a weaker dollar is a huge positive. It makes their dollar-denominated debt, which many developing nations hold, easier to pay off. It also makes their exports cheaper and more competitive on the international stage. Consider the intricate dance of international capital. When US rates are high, capital tends to flow into the US in search of better returns. This can starve other economies of much needed investment. A dovish Fed reverses this flow. Capital may now seek out higher returns in other markets, leading to a rally in international stocks and a boost to global economic activity. This is the central principle of a synchronized global rally. But there's another layer to this. The fear of an impending US recession had been a major drag on global growth expectations. Many countries are deeply intertwined with the US economy through trade and supply chains. If the US catches a cold, they catch the flu. By signaling a willingness to stimulate the economy, Powell has reduced the perceived risk of a hard landing, thereby lifting the global mood and encouraging a risk-on environment for investors everywhere. Now let's pivot to the world of crypto. The headline mentioned that risk assets like Bitcoin gained. This is no confidence. The relationship between central bank policy and the crypto market is a fascinating and critical one. In an environment of high interest rates and monetary tightening, crypto assets, which are often considered the ultimate risk-on assets, tend to struggle. Investors typically move their money from riskier assets like Bitcoin and Ethereum into safer havens like cash or bonds. This is a direct result of the cost of capital. When capital is expensive, investors demand a higher return on their investments, making speculative assets less attractive. Conversely, a dovish pivot from the Fed, which is a signal of future rate cuts and a potential return to quantitative easing, is like rocket fuel for the crypto market. Here's why. When interest rates on traditional savings and bonds are low, the opportunity cost of holding non-yielding assets like Bitcoin decreases. Why hold a bond that gives you a 3% return when you can take a risk on an asset with potential for a much higher return? Rate cuts increase the amount of money flowing through the financial system. This new liquidity often finds its way into speculative assets, driving up prices. It's a classic search for yield scenario, and in this search, investors often turn to crypto. For years, Bitcoin has been pitched as a hedge against inflation and a debasement of fiat currency. While this narrative was challenged during the recent inflationary period, a return to a more stimulative monetary policy can reignite this belief. If the Fed is going to print more money to stimulate the economy, some investors will seek out decentralized, hard-capped assets like Bitcoin as a store of value. The result is what we saw. Bitcoin and other cryptocurrencies surged in value not because of any specific blockchain innovation, but because the macroeconomic tide shifted in their favor. This is a powerful demonstration of how deeply integrated the crypto market has become with the broader financial system. It no longer operates in a vacuum. It is a barometer for investor sentiment and liquidity. The technology and artificial intelligence sectors are also profoundly affected by this monetary policy shift, and for similar reasons to small cap stocks. Tech companies, particularly those in the AI space, often operate with a business model that relies heavily on future growth and investment. Many are not yet profitable and depend on a continuous flow of capital to fund research, development, and expansion. When interest rates are high, this capital becomes more expensive to acquire. This can lead to a slowdown in innovation, a reduction in hiring, and a general cooling of the sector. The valuations of these companies, which are based on their long-term growth prospects, are also highly sensitive to interest rates. A dovish Fed changes the equation. Cheaper capital means companies can borrow at lower rates to finance their growth. This is a boon for both established tech giants like Nvidia and for smaller high-growth startups. The sentiment that Powell's speech created, that the economic environment will be more favorable for risk-taking, is a direct catalyst for this investment in the AI and tech sectors. It fuels the narrative of a new AI boom and can lead to a self-reinforcing cycle of investment, innovation, and stock price appreciation. This is why we saw major tech and AI-related stocks leading the rally. While the market's reaction was overwhelmingly positive, we would be remiss not to address the cautious voices. Not everyone believes this is a clear path to economic prosperity. Some analysts are warning that the markets may be getting ahead of themselves. The central concern is the possibility of stagflation. While Powell hinted at employment risks, he also acknowledged that inflation pressures remain a concern due to a variety of factors, including President Donald Trump's new tariffs. If the Fed cuts rates too quickly and inflation remains elevated, we could enter a very difficult economic scenario. This is a delicate balancing act for the Fed. They are trying to land the plane softly without causing a recession, but they must also not reignite the inflationary fires. Furthermore, there is the risk of political influence. influence. President Trump has been a very public and vocal critic of Jerome Powell, often pushing for rate cuts. This has led to concerns about the Fed's independence. Some investors worry that the Fed might be cutting rates not just based on economic data, but also in response to political pressure. If the market perceives the Fed as politically compromised, it could undermine confidence in the entire financial system. These are the undercurrents that every astute investor must be aware of. While the immediate reaction to Powell's speech was euphoria, the long-term outlook is far from certain. The path forward is not a straight line, but a treacherous one. We will be watching closely to see how future data on inflation, employment, and economic growth shapes the Fed's next moves. So what have we learned? A single speech by the head of the world's most powerful central bank has the power to move trillions of dollars in capital, affect the valuation of companies large and small, and even dictate the direction of the crypto and AI markets. The headline, "Stocks Gain as Rate Cut Bets Rise on Powell's Speech," is an oversimplification. The real story is a complex tapestry of interconnected forces. A central banker's subtle shift in language, a market starved for good news, a global financial system that hangs on every word, and the fundamental mechanics of how monetary policy affects the flow of capital into every corner of our economy, from the factory floor to the digital ledger. The rally we saw is a testament to the power of liquidity and the eternal human desire for growth and prosperity. But it is also a reminder that in this new era of finance, you cannot look at any single asset in isolation. Everything is connected. The Fed, the dollar, the stock market, AI, and blockchain, they are all part of the same dynamic and ever-evolving system. We will continue to track the story and bring you the deep insights that you won't find anywhere else. Thank you for watching.